Fingers crossed. Get it to work. All right, cool. Except I can see myself. Fingers crossed. All right, let's kick this thing off. So I am going to share the screen with you. And if you guys can't see it, please let me know. I'll make it larger. Does that work for everybody? We'll talk about it, make it bigger.
Looks fine.
Yeah, okay.
Yeah, everything looks great.
All right. Fantastic. I think we have everybody in the house. Let me just open this up in case anyone else jumps in. All right, cool. So here, I'm gonna make it a smidge bigger for you guys. So they just changed the loan limit, you guys. First and foremost, you need to know what your loan limits are, right? And what is a loan limit? So Fannie Mae and Freddie Mac, there are two government agencies that do all loans, majority of loans, I'd say 9 out of 10 loans for everybody in the United States. They have limits as to how much they're going to lend you for a conventional loan. So because we are in a more expensive area here in San Diego, we have what's called a high balance loan limit, okay? And so that high balance loan limit allows us to go up over the conforming loan limit. Like for instance, if you go up to Riverside County, you guys, okay, in Riverside, they don't have high balance loan limits. So you're cut off right here at this 726,200. If you wind up buying here in San Diego, you can still wind up buying almost $2 million with 5% down. You can't do that up in Riverside. Okay. So really important. I mean, just that small little takeaway, you guys, just be mindful when you're going up there, because this applies to FHA loans as well. And so if you have an FHA buyer that's going up there so that they can afford a little bit more, be mindful that that little bit more is cut off at that 726, where they can definitely buy more here with that just that 5% down. And that only pertains to one unit. If you buy a duplex, that number goes up. If you buy a triplex, a triplex, that number goes up again. I mean, you're at $1.5 million and you're still can just put 5% down to purchase that property if you're living in one of them. Okay. If you're not living in one of them, it's a different story. We'll cover that in a second. But if you're living in one of them, you can literally almost $2 million for a 4-unit. Now, you're going to ask me, next question is, who's got a 4-unit for 1.89? It's going to be tough to find, but you can finance it with 5% down, which is the good news. Questions? Loan limits? No? Perfect.
Just hosted a fourplex for 1.395 this weekend.
Dang, Skippy, look at that. 5% down. Somebody could buy that.
Yeah, absolutely great investment. I'm not sure why it's been on the market so long. I mean, if I could, I would.
And what is it? Is it a technically a fourplex, or is it a single family with 3 ADUs?
I mean, it's considered a fourplex. It was a 2 beds and 1 bath, and then there's a studio attached in the corner, completely separate, and a different building that has 2 units with 1 bed and 1 bath.
Wow, that's pretty sweet.
Yeah, I thought so too.
That is pretty. So yeah, again, you guys, something like that, 5% down.
Where was this one at?
What were you saying?
This was a national city. That might have been, I think a lot of people weren't really sure about the neighborhood, but overall it was in a great street, met a lot of the neighbors, and they all seem to like living there. So
very cool.
It was off 5th Street. Yeah.
Yeah, can you post the address by any chance? I might have somebody for that.
Absolutely, will do.
Thank you. Sorry, Ed.
No, don't be sorry. Perfect opportunity right there. So selling agents, you guys, please be aware when you go into a property and you're going to list the property, you have to have, by state law, smoke detectors in the homes in front of every single bedroom leading to that room. And there's got to be carbon monoxide detectors in the house as well. And that water heater has got to be double strapped. Super important. Don't delay the loan. Don't delay a game. Don't make people incur additional costs of having to send somebody else out there to get this stuff done. If you do your initial walkthrough, keep your eyes out for smoke detectors, carbon monoxide detectors, and double strap water heater. It's a California law. Cool. That was your one public service announcement for the day. So getting back to conventional loans, y'all, there's always going to be credit limits, right? So there's the 3 C's that the underwriters are going to look at. And that's basically what we're talking about here. They look at collateral, they look at capacity, and they obviously look at your credit, right? So what credit scores are required? So for a conventional loan, you just need a 620 credit score. So it used to be from 620 all the way up to like 640 it is. And then 640 to 660, 660 to 680, 680. So every 20 up until 720. And then it was AAA credit. All of it was the same. So as of this past Thursday, Fannie Mae announced, hey, we're going to have additional credit tiers now all the way up to 780. And so what's that going to do is that it's going to actually make it a lot less expensive for people with less credit, with less powerful credit, with less not as good credit. And then it's going to be a little bit more expensive for people with great credit because they're actually going to have an adjustment to their interest rate, which they didn't have before, which is pretty interesting that the fact that they did that. But yeah, so we're going to have additional credit little niches there all the way up to 780. 620 is a minimum. So down payment, like I said, up to that 726, you guys, you can put down 3% to purchase a home. Not a lot of money. I mean, that's only like $21,000 if you're going to be buying a $700,000 home. If you don't have $21,000 saved up for down payment, you probably shouldn't be buying a home, right? I mean, $300,000 property, if we can find one, we're desperately searching for them. If you come across one, you will wind up only paying, $9,000 for down payment. I mean, granted, usually closing costs are between 2 to 3% of the purchase price. So just keep that in mind. But yeah, no, seriously. The 3% is fantastic. Anything above that 726, remember to that high balance loan at 977,500, 5%, right? If you're going to be buying a duplex, we're going to need to put 15% down, right? And if you're going to be if you're purchasing a 3 to 4 unit, it's 25% down. Okay. Did I say 5% earlier? I did, didn't I? That was my bad. I haven't finished my cup of coffee yet. I'm so sorry. So when we are buying more multifamilies, we do need higher down payments. I had a brain fart there. I apologize. So if we're buying multifamilies, we do need more money down, you guys. All right. Second homes, 10% is the minimum. Okay. And then for an investment property, it's 15% for 1 unit. All right. And if you have any kind of multifamily, you have to put at least 25% down, you guys. All right. And that's just for conventional loans. Question so far. Cool. So moving right along, like I said, we have credit. So 620 is your minimum credit score. Collateral capacity to pay back the loan. Another thing we got to worry about with credit, you guys, is that you have certain waiting periods that you have to abide by. So if you have some sort of credit event in your life, a bankruptcy, a short sale, a foreclosure, if you deed in lieu of, you do have to wait certain periods of time in order to be able to qualify for a conventional loan again. Now, there are ways to shorten those periods of time by looking at different types of loans. But with a conventional loan, it's got to be at least 4 years, as you guys can see, for your deed in lieu of and your short sales. You got 7 years on foreclosures and then 4 years on a bankruptcy. Okay. You have mortgage cost insurance if you don't put 20% down. It is a huge myth, and for some reason, everybody believes it, that you can't buy a house without 20% down. But those that aren't in a know, now you know. You do not need to put 20% down. That just avoids mortgage insurance. And mortgage insurance is based off of credit. So if you have good credit, you're going to have lower mortgage insurance. And you're honestly talking, I mean, literally up to that 726 mark. It could be $100 a month if you have great credit. Like we took a look at Dave Savage kept telling people, oh, I don't know if you guys have ever heard Dave Savage. He's a big financial guru, written books about finances and debt. And I'm a believer in a lot of what he preaches. However, he's a strong, firm believer in no debt at all. I think there's good debt and bad debt, right? Good debt being a mortgage is a great debt because you get to write off that interest and kind of leverage yourself and borrow money in order to, borrow a lot of money with just a little bit of down and be able to capture that appreciation of that asset, right? So in the investment scheme, I don't think that that's 100% accurate. However, he had always recommended that 20%. If you took a look over the past 5 years and you took that mortgage insurance instead of putting that 5% down and you had just invested that extra 15%, you would have made so much more money on that 15% than you would have paying mortgage insurance. And then you could have eliminated that mortgage insurance because with a conventional loan, once you have 25% equity in your home within the first 5 years, from years 2 to 5, or greater, you can just petition the bank to remove that mortgage insurance and it's gone. You provide them with an appraisal and they remove it. So why wouldn't you want to do that? It's not a bad thing. Mortgage insurance, I mean, granted, you don't want to have to pay it if you don't have to, but it allows you to get into a home for less money out of pocket, and it's substantially beneficial, especially if you have a good investment advisor that can help you make money on your money. All right. Questions about mortgage insurance. I don't want to read this thing to you. I'm just going to kind of talk to you guys about it. I'm going to let you guys read it. You guys can all read it, right? It's big enough on your screens. Yeah. Okay. So please shout out questions if you have them. There are different parameters to when you can eliminate that mortgage insurance, just so you know. The first 2 years is mandatory. You have to keep it. After 2 years, between 2 to 5 years, you have to have 25% equity would have had to be built in that house. And that would have happened in the past couple of years, right? So if you have someone that bought 3 years ago, they could probably get rid of their mortgage insurance at this point. But then it also is only 22% after that. I will send this to everybody on the call. I'll take a snapshot and I'll send this to everybody. Absolutely. So after 5 years, it's just 22%. But up front is that 20%. That's where that comes from. All right. So moving along, condos, you guys, condos have certain parameters that y'all got to be careful about. And every bank is very, very different about how they handle condos. Most big banks and credit unions, as soon as they hear the word litigation, they're out. They won't even look into it. They don't care. They're out. It's too risky for them. They don't want any part of it. However, Fannie Mae guidelines state that even if it is, there is litigation there, it just depends on the type of litigation will determine whether or not somebody needs to, whether or not we can finance a condo. Okay. And so that type of litigation is against the HOA. Usually construction defect litigation is what prevents us from financing there. Slip and fall type of stuff is not a big deal. What happens is the bank has to reach out to the insurance company for the HOA and make sure that there's enough insurance to cover whatever kind of litigation is going on. And if they're fine, it's not a big deal. We can move on. We just need to make sure that we're abiding by some of the other parameters, including you got to watch out for a lot of delinquencies. For instance, you can't have more than 10% in delinquencies. I don't think I even have that up there, but I can add it up there. You can't have more than 10% of delinquencies in the entire complex. So if like I live in an HOA, there's 31 homes. If more than 4 properties are in delinquent for their HOA dues, you may or may not be able to finance them there. We could probably get around it because we have a very close relationship with Fannie Mae, and we'll just directly ask for an exception to this one rule. Say you had 5 out of 30, right? And they might give us that exception. But if a bank sees it, like a big bank or a credit union, they're just gonna, nope, it doesn't meet, nope. And a lot of them have their own guidelines. A lot of them will say, for instance, one of the things that you'll hear out there is that you can't have more than 20%, right? Ownership by one entity. But think about it, right? You have a 10-unit complex. Somebody owns 2. Now you have 20%. They own that third. You can't do a loan there? Like, that doesn't make any sense. You can. You just got to ask Fannie Mae permission. And you got to ask, and they're always going to look for that owner occupied. So if it's an owner occupied person coming in there, thumbs up all day long. They want owners to live in the condo complex. If it's an investor, it might be a different story. That's why one of the other parameters is like, hey, you need 51% owner occupancy, right? But that's only to do an investment. That's not to do an owner occupied. And banks, credit unions will say across the board, if there's not 51% occupancy, we can't do a loan in there. It's not true. I'm here to tell you it is not true. Owner occupied all day long, we can get them into that complex. But you'll get shot down in the middle of an escrow with a big bank because they just don't know any better. Or they just put their own guidelines on above what Fannie Mae and Freddie Mac guidelines. And those are called overlays, y'all. All right. If you ever hear that word, this bank has an overlay. It means that they have their own rules that they put above and beyond what Fannie Mae and Freddie Mac require us to have. So those are some of the guidelines for condos. There's also another types of loan called renovation loans, you guys. So especially now that these loan limits have gotten much higher, if you do happen to find like a $500,000 or $600,000 unit and your client qualifies for more than that, and it needs a little TLC, you can actually fix into that into the purchase price, into your loan, the renovations for the loan in advance. So the loan does take a little bit extra time. We do have to send out a contractor out there, or the client has to send out a contractor. We need to get a formal bid from that contractor, being very specifically spelling out exactly what they're going to be doing to the property. And then once we get that bid in hand, when we order the appraisal, we give the appraiser that bid. We tell them that, hey, this is a renovation loan. This is what's going to be done to the house. And then they go, and instead of doing an as-is appraisal, they do an as-if appraisal. Okay. And they look for other properties and they compare to other properties with the same type of work that's done, all right, to this new house. So say they're going to be adding a bedroom, or they're going to be adding a garage space, or they're going to be building an ADU, or what have you. I don't think you could build an ADU, actually. I stand corrected with the renovation loan, not yet. I'm sure that's coming down the pipe. But they can add on, for instance, right? They can do all sorts of fixing. So they can redo an entire kitchen. They can do all the floor, whatever. They're going to find something that is comparable, all right, to as if this was already done. And that's how we would lend on that property. And they're available through conventional and through FHA in case someone has slightly lower credit scores. And they're also available for investors, just so you guys know. So they can finance some of the renovation costs up front. How's that? Questions? Conventional loans. Ideal. If you can get them, we want to get them. All right. They're very, very easy to do. They require minimal documentation, and they're definitely the most streamlined product out there. Matt, what do you got?
Yeah, we're gonna close a conventional loan here in 15 days. We got one on, coming down the pipe today, and we're gonna close it because we underwrite up front, and because it's conventional, we'll knock it out of the park.
Yeah. I mean, we just opened up escrow in Texas last week, and I told him I can close this Friday, and he's like, what? What do you mean? I don't get it. Well, I had him underwritten. Like, all I needed to do is check out the house. We got an appraisal waiver automatically. We don't need an appraiser. We need title and escrow documents, and we're done. It's that easy. So, good stuff. FHA. Matt, do you want to do FHA? You want me to keep going? All right, I'll keep rolling. So FHA loans, y'all, does not stand for first-time home buyers. Let me repeat that. FHA are not first-time home buyer loans. It is for credit challenged individuals. All right. You could have owned a home before and get an FHA loan. That's okay. You can only have one FHA loan at a time. But FHA loans, if you have poor credit, that's the only time we really look at FHA loans. That, and if we need to kind of push the debt to income ever so slightly higher than 50%, we might also examine an FHA loan, but otherwise we stay away from them because what's the point of incurring upfront mortgage insurance when you don't need to? So the big difference here, right? Lower credit score, it makes these loans and the ability to purchase a home that much easier on people. Okay, so lower credit scores, higher debt to income levels. So typically you get limited up to maybe 50% if you're lucky. Okay, on a conventional loan, we've been seeing more and more people, because of their credit, the algorithms have kind of changed, and now they're getting kicked down to 47, sometimes 45. I've seen them down to 43. You can't get an approval above 43% debt to income, because the clients are just, it's a little bit, they see other risk factors involved, like high credit utilization. These people are taking out a lot of credit card debt or what have you. They're not paying they might be paying it, but they're paying minimal payments. Fannie Mae looks at that. Are you paying down your credit, or are you just paying it as it goes? So there's all sorts of really small little innuendos like that in the algorithms that they use to kind of figure out how much they're willing to stretch themselves to give to you based off of your purchasing power. So say you can go 50% with FHA, you can go 55. Okay. VA can go all the way up to 65. Now, when I start seeing somebody going 65% on a VA loan, I'm going to have a heart-to-heart with them, you guys. With all due respect, I love my veterans to death, but if you're going to be spending 2/3 of your pre-tax income on your house, I don't want you to be having to live on ramen noodles, okay, while you live in that house, and then call me 2-3 years later and be like, I can't afford it. I need to sell it. I'm buried in debt. Help me, get me out of debt. So I do have heart-to-hearts with my clients because I don't necessarily agree with going that high on a debt to income. Think about it. I mean, 2/3 of your income is going pre-tax. How much are taxes? 30%? What do you live on? 5% of your income? Like, I can get an approval, I can get you the house, but you're not left with much to live on. So we definitely have conversations, and hopefully there's another person that's contributing to the expenses at that point, right? So look, with FHA, it limits you to that 977, 500. You can't go over that, but that's still a boatload of money to be borrowing to purchase a home. FHA has to be owner occupied. You cannot be purchasing a FHA as an investment. Short sales and credit events and bankruptcies have shorter terms than conventionals. All right. So that's another reason why we would look at FHA, because they can get into homes a little bit sooner if they had some credit events. And they're all listed right there. Mortgage insurance acts a little bit differently with FHA than it does with conventional. With conventional, you just pay on a monthly basis. You can choose to pay it in a lump sum. You can choose to split it with the lender, or you can just have the lender pay for it. And when the lender pays for it, they fix it into the interest rate. You're still paying for it. It works a little bit differently. It's in your payment, and it's actually tax deductible that way. So whereas MI is not tax deductible for everybody, there's income limits as to where you can and cannot deduct it. So it may behoove you to do something like that. But mortgage insurance with FHA, you have to pay upfront 1.75% of the purchase price of that home, right? Of the loan amount that you're borrowing for that home, right? Into what, like a big account basically that everybody puts money into, that takes out an FHA loan just in case that person defaults on their loan. There's money to pay the bank back. So what's the government doing essentially is that they're ensuring that they're going to pay the bank, right? And by them insuring that loan, they're actually taking some of that risk away for the banker, right? And that way, as a government loan, it's going to have lower interest rates, and you'll see them lower anywhere from 25 to 50 basis points. So sorry, 1/4 to 0.5%, right? Lower than a conventional loan, but again, you're getting that money tacked onto your loan amount, and that's kind of a kick in the how you doing, because when you go to sell it, especially if you sell it in the near future, you may be underwater because you may not have even paid off that additional money that they're tacking onto your loan. So be mindful of that, especially if someone tells you they're only going to be in the house for a short period of time. And then it's a very fixed way of calculating it with FHA, whereas conventional is really based on a whole bunch of variables. There's like 20 different variables that go into determining what a conventional mortgage insurance rate is. Not with FHA. It's streamlined. Like this is it. So if you have a really bad credit score and you're trying to buy a house, and usually if you're under 700, not necessarily that's a bad score, but if you're like 600, and you're still qualifying for FHA, and you're not qualifying for conventional, or even you're qualifying for conventional 620, 630, like we're still going to look FHA, because that mortgage insurance will be hundreds of dollars as opposed to here it would be significantly less. So some agents don't understand government loans like FHA and VA, and they're like getting really sketched out about it. And they're like, oh my God, the appraisals are just so much harder. And like they nitpick on the appraisals, but that's not necessarily true, y'all. Yeah, I'm here to tell you that the only thing different about FHA and VA appraisals is that they look for health and safety issues, which they should be looking for conventional loans as well. If you have a fence that's leaning, if you have a railing that's wobbly, if you have cracks in, say, your driveway that are actually like pushing up and are a tripping hazard. Okay. I had one where there were roots that got underneath someone's walkway in the back, and it was all bricks, and there were bricks like sticking up like an inch. Like this thing was just basically sticking up out of the ground. So, I mean, as an agent, wouldn't you want to call out somebody that like, hey, can you fix that brick before I move in so we don't trip like when we go walk into the house? It's probably something that you're going to ask them to fix, or that you can get it fixed yourself. But I have had VA and FHA appraisers come in and call something like that out. Exposed wiring, I mean, these are like things that you're probably going to ask them to get fixed anyways if it's a conventional loan. So I wouldn't sweat it,
Exposed wood.
The termite damaged wood.
No, just exposed unpainted wood. They'll call that out too.
Yeah, termite damage outside. If there's leaky calcium deposits around hoses somewhere, it could be signs of a water leak. Obviously, you want that taken care of. So they're going to look for things, yes, that a conventional loan may or may not call out, but there's just the same possibility that conventional appraiser could call that same thing out. So don't be scared of taking VA and FHA loans. So that's kind of the big thing to look out for, health and safety issues. FHA also has a couple of really weird rules I'll tell you guys about. One of them being the flip rule. And a lot of jumbo loans as well, you guys, have flip rules. So anything over that 977-500 turns into a jumbo loan, okay? They become much more strict. They have lower loan to value. They have lower debt to income ratios. They require reserves. They're very different in their calculations of their income. So there's no flipping properties and being able to use an FHA loan until the 91st day. Okay. So you can't write an offer and date it within 90 days of that last purchase with an FHA loan. Okay. It's got to be the 91st day. And if it is written within the 90 days, we have to rewrite it and get re-signed. All right. So you can technically get into escrow, but we will kick that back and have you get into escrow after that 91st day. So, and then there's also another wonky rule too. If you're going to be buying a multi-unit, there's a net tangible rule, which I bumped into years and years ago and stuck with me for the rest of my life because it really screwed me up on one of my loans. Something that you learn, you never forget. If you're going to be using an FHA loan, because you can with FHA, unlike conventional, you can move into that property as an owner occupant for 3.5% down for a fourplex. I did it when I was 24 years old. However, the rest of the mortgage, the rest of the rent payments, the other 3 units, they have to cover all the expenses for that house. Same thing with a triplex. The other 2 units have to cover all your mortgage expenses with that house. So it's a net tangible rule. It only applies to FHA, but it's a really weird curveball. So be mindful. You can get someone into a multiplex with very little down, you do have some nuances in being able to close that loan. Okay. And you'll only know what those are. If you don't have the leases, then we would have to order a special rent schedule on the appraisal, and they'll provide us what market rents are for that property. And we can use 75% of that. Yeah, super easy. It never happens. Just not here in San Diego. So condos, you guys, it's not like conventional condo approval that we order a condo questionnaire, we order insurance, we order their budgets, they send it to us. Condos with FHA are actually on a condo approved website. It's an FHA website. It's a .gov website. And so we need to be mindful that we're not just saying, yeah, sure, no problem, we could do an FHA loan in here, because it might not necessarily be on that approved list. So it's really, really important that we check that for you. Okay. Part of having it approved is a 51% owner occupancy, but that's getting it approved. And so these projects, they have a certain finite expiration date as to when they need to get reapproved. So when we go and visit the website, and the website's right here, and let me just show you what it looks like so you guys can see it. We want to make sure that if you're looking it up, you're looking at a website like this. Okay. It's the .gov website, but you can also email it to us and we'll gladly look it up for you. Not a problem. And just like conventional loans, FHA loans have renovation loans to them. So we can fix in all the renovation for that property, which is pretty sweet, especially right now, where there's not a lot out there. So if you are out there showing people and they like the neighborhood, they like the bones of the property, don't shy away from calling us and asking about renovation loans and seeing if maybe we can get one done in that property, because we might be able to build out the house the way they want it, and they can still get something sooner rather than waiting for their unicorn to show up in San Diego. It's going to be kind of tough. All right, FHA loans. Questions? All right, cool. So far, so good. Usually it's either people are sleeping or it's too early, but it's 10:30 already. But you guys are getting
another crazy misnomer that you guys made say is like, oh, I got to go FHA because it's the lowest, down payment. And that's not true. Like Eddie said before, conventional is 3% and FHA is 3.5%. So depending on their credit situation, conventional is definitely the way we want to steer them first until that option's taken off the table, and then we got to go FHA.
Absolutely. No, thank you for reiterating that. It's super important. So FICO scores for VA, just like with FHA, they're a little bit lower. It's a government loan. We can go all the way down to 580. Now, mind you, when we start getting under that 600 level, we do need compensating factors for that lower credit score. Compensating factors being they've got money in the bank, they've been on their job for a long time, steady job, steady income, low debt, low DTI. So we need something in there. It was like, oh, come on, I know you got bad credit, but like we got all these other good things. So come on, give us a chance, right? So we can get it done. It is more expensive. So you guys understand, interest rates are credit based. So even with the VA loan, there really aren't many adjustments to the rate. Same with an FHA loan. There's a ton of adjustments when it comes to conventional loans, but there really aren't when it comes to government loans. But when you start having lower credit scores, there's some big adjustments because it's really, really risky to start lending out a lot of money with 3.5% down and bad credit, with no money down and bad credit, because people don't have skin in the game, right? So what's to stop them from just walking away from the house? So just keep that in mind. With an FHA loan, it's insured. Remember, these are guaranteed. VA loans are guaranteed. So again, you're going to have lower interest rates. They don't need to put any money down. As a matter of fact, a couple years ago, they even got rid of the loan limit on a VA loan. There is no limit, which is pretty sweet. You can do a $2 million. I think we have an internal limit of $2.5 million, I believe, on a VA loan.
3 mil.
Did they bump it up to 3 now? Yeah.
Bumped it up. Yeah.
So we can go all the way up to $3 million on a VA loan, no money down.
No money down.
It's kind of crazy. But I mean,
Thank you. Thank you for your service.
they still, yeah, I mean, absolutely 100%, but they still look at your debt to income, obviously. That's got to fall into the parameters, and they're also going to probably look for reserves at that point. And they're going to want to have you having some money on the sidelines just in case you do lose your job. So no more limits. You can have more than one VA loan at a time, y'all. However, if you buy a property in San Diego, you probably won't have any entitlement left to get another one. I have seen people purchase homes in, say, like Jacksonville, Florida, somewhere out in the Midwest, low, Texas, having $150,000 loan, and then them come out here and they have quite a bit of entitlement left, and they could still use it out here. There's a really complicated formula to figure it out. Surprise, surprise, the government gave us a complicated formula. I threw this formula in here just for giggles so you guys can see it. But this is the formula to figure out how to calculate entitlement, and to figure out how much new stuff they have left. So maximum loan amount, required cash, guaranteed loan amount. I mean, yeah. What do you mean by having entitlement left if there's no loan limit? So they still allow you. Stacy had a great question. It was just a direct message, so I don't think you guys saw it. So she said, what do you mean by having entitlement left if there's no loan limit? So you're entitled as a veteran to have X amount of dollars for a home loan, okay? And it's all based off of this $36,000 entitlement for all loans over 144. So now what's really strange is the way that they calculate this, okay? If you wind up using all of your entitlement to purchase an expensive home, you're not going to be left with any to be able to use that VA loan again for another home. And that calculation, because it's based off of a purchase price, right, is skewed towards higher purchase prices at first. If you buy a less expensive one, it doesn't impact your entitlement, so you still have some left. If you buy something more expensive, it affects that entitlement a lot more, and you may wind up using it all, and you're not going to be able to you're not going to be able to buy anything else. So they're mutually exclusive concepts. One gives you the entitlement to purchase a property, but yet there's a loan limit on most loans, not on this, as to how much you can use. How much you used is going to affect how much you have left over. I hope that answers your question. Does that make sense? It's kind of confusing.
Kind of, sort. I don't quite. That's where I'm kind of lost on.
I'm sorry, you broke up there. What did you say, Stace? You kind of broke up there. So
You might be in a bad spot.
Yeah, so I leave this calculations to the underwriters because I don't want to screw it up. But just understand that if it's less than $144,000, okay, it's not going to impact you as much as if you wind up borrowing more than that on your first go round. If it's a first go round, it's going to impact that number because you have to take into account the sales price. You multiply the sales price by 75%. You have to subtract what you have left over that you calculated up here from this number. That gives you the maximum baseline. Now you take 90% of that number. I mean, it's just such a stupid calculation. But all you guys need to know, right, is that you are entitled to a VA loan. You can purchase as much as you want with your first one. You may not be entitled to a second one after that first purchase. That's basically what it boils down to. The calculations, we're going to leave that to the professional underwriters that are responsible for doing this and do it every day, all day long. I just wanted to show you that it is really complicated to figure it out. But we do need to figure it out. So if someone tells you that they already own a VA property, let's look into it. All right, cool. You got that? Sweet.
Does that have like a set time limit? Like if they wanted to get like a second property?
You can't use it for a secondary property. It has to be owner occupied.
Okay.
Yeah, so you have to be living there. That's another nuance. Same thing with FHA loans, VA loans, they have to be owner occupied. No second homes.
Right, but you can have 2 owner occupied VA loans.
You can if you have entitlement left, yeah.
So
Yeah.
say you're living in Virginia and your family's in Virginia, your wife and your kids, or your husband and your kids are in Virginia, and you get deployed to San Diego and you need to buy a condo. You still got your place in Virginia, and now you need to buy a condo with whatever's left over with your entitlement.
Exactly. Depending
You
on
could
how
have
much
2.
entitlement you have left, how much allowance you have left will they'll tell you how much loan they can give you using that VA loan.
A quick question. So for example, would it be a thing where you own one and then you end up buying another one and just rent the other one, or do you have to live there, or like family?
A lot of veterans do that, and I think it's a great idea, but what they'll do is they'll actually refinance their original purchase into a conventional loan, and then that will open up their entitlement again, so they have 100% entitlement, and then they'll go and move somewhere else.
Got it. That
And
makes
they'll-
sense.
And they'll rent that place out.
And Sheldon, the only difference to that is if you look at the graph or the chart on Eddie's screen, it would go from first time usage to subsequent usage as far as the what they're putting as far as the funding fee.
So
Got
thank you for bringing that up. I'm going to jump right to that section. I'm going to just tell you guys that just like FHA loans, VA loans have lower credit waiting periods than conventional loans. Conventional loans are the strictest, all right? So that being said, let's move on to, there is no mortgage insurance on FHA loans. It's called a funding fee. Same thing, same concept, right? With FHA loans, they take that money, they put it into account. That account, it goes to pay off anyone that defaults on the loan. It insures the loan, right? That's why you have lower rates. VA loan, funding fee goes into an account. Veteran defaults, they have money to pay for it. They have a guarantee to pay for it. They don't just insure it, they guarantee it. Again, lower interest rates, less risk to the bank because it's guaranteed and insured by the government. Cool. So in order to get that money though, they need to charge that money up front. 2.3% if you don't put anything down gets added to the balance of the loan. Okay. Use it a second time, it's 3.6%. So I refinanced, I got stationed somewhere else. I'm going to use my VA loan again. It's 3.6% gets tacked on. It's pretty big. Yes, the fee will be waived. Great question. If you have disability. And that will show up on your certificate of eligibility. It'll pop right up there. It'll say exempt. And then it'll give us how much disability income you're receiving. And so I have a friend of mine that just got a Purple Heart, and he was actually refunded his funding fee. Veterans with disabilities have a lot of benefits as far as, especially in the state of California. So it'll be something that I would definitely encourage all my veteran peeps that do have a disability to reach out to the state. He's gotten lower property taxes. He doesn't have to pay for like car registrations and stuff like that. So there's a lot of benefits that when you do become disabled, especially with the Purple Heart. But so he was just telling me yesterday about, the fact that his monthly payment went down $200 because his taxes went down, right? So property taxes get reduced significantly for our disabled veterans, which is awesome. And this will be waived if you have a disability. So you guys know. If you're applying for a disability and they just got out of the military, and they haven't gotten it yet, they'll probably tack it on, but then they'll get it refunded later on. So that's not to worry about. Just like FHA loan, but a great question. Thank you. Just like an FHA loan, VA loans, health and safety issues, right? They're protecting the borrowers, you guys. That's all that they're doing. and it's a good thing. So of course the seller doesn't want to put a couple extra $100, a couple extra $1,000 into fixing up their house and making it safe and secure when they sell it to somebody else. But the bank's going to require it. It's usually not that. Termite pointers. So it's another kind of issue that some listing agents have with VA loans. Oh my God, they're going to require termite repairs, blah, blah, blah. Well, you know what? They do, but the seller doesn't necessarily have to pay for it. The buyer could pay for it. Now, why a buyer would want to pay for somebody else's home before they close on the loan, I don't know. But they could. They could pay for it out of their own pocket. Seller could pay for it. Buyer could pay for it. You could pay for it as an agent. Anybody can pay for it, to be honest with you. But you have to take a look and see what's on that report. Section 1 clearance, mandatory. Section 2 clearance, not necessarily mandatory. However, if it has to do with water damage, they're going to call it out. They're going to have to make you fix it because it can become a lot bigger problem down the road. So they will call out certain Section 2 clearances that are mandatory. Not all of them, but it's on a case-by-case basis. All right. And go ahead.
I got a question. I mean, I know we're in VA right now, but it might or might not be relevant to VA. I had a question this morning about a termite report that came back and pointed out some wood damage that wasn't on the appraisal. How does that go about getting? Who decides on what gets fixed and what doesn't?
So there's two separate reports, right? That the bank is going to receive. For a VA loan, termite, they got to get the termite report. Especially here. It's not everywhere in the country, by the way. It's specifically here because we're a high termite area. Come to find out, I got a couple of clients in Massachusetts to waive any kind of termite stuff because it's not required there. So here, though, it is. So you get a termite report, you also get an appraisal. Sometimes the appraiser will walk around, he'll look at the eaves and he'll be like, oh, there's termite damage to the eaves, right? And he'll call that out because there's damage to the wood structure that's holding up the roof. Sometimes he won't. An appraiser, a termite inspector will probably call that out because that's work for them, right? So they're going to call that out. That's going to be needed to be fixed. Either or, whatever report that it's on, if an underwriter sees it, they can't unsee it. It's going to need to be fixed. If it's a Section 1 or if it's some sort of Section 2 issue that could be potentially
even on conventional finance.
Not on conventional.
Not on conventional finance. That's what I mean. I know we were in VA, but this was a conventional.
It depends what's in the report. I mean, it depends what's on your RPA. So if you have a termite report in the RPA and you request it and it comes back with damage and you show it to the underwriter, they're probably going to ask for it to get fixed. If you see that it comes back with damage, don't give it to the underwriter. Don't give it to the bank and just give them a new addendum and remove that report. Take it out. Take it out of the contract. And then if it's not part of the contract, they're not going to look at it. But they're not going to ask for it to get fixed on a conventional loan either, unless it's negotiated in there. If you put termite report and clearance on the contract, you got to clear it. If you just put termite report, they're not necessarily going to request it unless you wind up asking. Cool. So you guys can read all this stuff. I'm going to send this to everybody just so you all have it. Matt, did you by any chance take a snapshot of everybody that was on the call so that we can make sure we send it?
I didn't, but I can.
Oh, sweet. Thanks. And then there's one other nuance I want you guys to be mindful of in VA. It's called non-allowables. So there are some banks out there like Veterans United. I know that does this. I know Navy Fed does this. They charge what's called an origination fee. Okay. And all that an origination fee is a bank charging a fee to do the loan. Now, there's different types of fees that they can and cannot charge. If they charge a straight up origination fee, you're going to be limited to what other expenses that you can pay with your closing costs. If they charge processing and underwriting fees, it's still considered an origination fee, no matter how they word it. You're gonna be limited to how much you can charge. We do not charge veterans anything to do their home loans for them because we're a military-owned bank. One of the owners served in the war a long time ago, and he made it his mission to give back to all of our veterans, and we don't charge anything. Normally it's $16.90. It's like $9.95 for underwriting, $6.95 for processing a loan through movement. We don't charge a thing. So we don't ever bump into this. But if you have a 1% origination fee, you're not allowed to charge for an appraisal, for a notary, for title, for escrow, for anything to do with the loan. So be very, very careful what bank you're going with. And you have to make sure, if you have a veteran client, to ask that banker, that lender, hey, do you guys charge origination fees? What are the fees that you're charging? Because you can get in a really bad predicament at the end if they're charging that fee and they're trying to double dip on this stuff. It could kick at the very last minute, and all of a sudden they're not going to be able to close this loan because they're going to wind up asking somebody else to pay for this, and that's a swift kick in the how you doing. So be mindful, you guys. With condos, last but not least, with condos, just like FHA, condos have their own website. It's a government website. I'm getting yelled at for opening up a government website. So when you go, if you just type in VA condos, scroll down to the bottom here, it says condo report. When you click on this condo report, what I would do, don't put in a name, don't put in an office, just choose California and maybe put in a city, okay, or maybe a county. But don't put in anything else, and then just get the list and go down the list and see if it's in there. See, now the way that they do theirs is really wonky, and this is why we always suggest that let us look us up, because sometimes they'll do it by address, right? They'll do it by address. Sometimes they'll do it by name of the HOA. Sometimes they'll do it by what else do they do it by? Tract. So over here, like a tract number. So you got to know how to look these things up, because I have found, and sometimes they're misspelled. So I'll intentionally misspell something like searching for it. We had that one up in Escondido.
Well, the worst part is, right, is on Redfin or Zillow, is they'll put in these HOA names, and the HOA names are wrong. So we have to dive into the deed of trust to look at the actual name of the property or the tract number to actually get the right ones, because it might be like the top one there, City View Terrace, but the real name is Terrace at City View. You're never gonna find that condo name on the VA site. So don't always rely on the Redfins and the Zillows or even the other agent for the HOA name. You really got to know what it is before you find it on that VA site.
You guys all familiar with what a legal description is? Do you guys all know what that is? Let me show you real quick. Oh, I might not be able to pull next talk. Let's look up Watson Way here real quick. So I'm on a title website. If you guys don't have a login to a title website, I strongly recommend that you get with a title agent and get it. I like First American. Lawyers also has a pretty decent one. It gives you all the information of ownership and all the nuances to any property through the property profile. And it's really important to kind of do your due diligence if you're going to be looking up a property, especially if you're selling it. You want to make sure that you take a look at it and you're talking to the right people, because this will tell you who the owner is, right? So for instance, this one, I'm just going to look at it real quick. I'm going to run the combined report. right? And what it's going to give me is it's going to give me a breakdown of the property. So who owns it and then what the legal description is. So in this one, it's lot 15, Porch Terrace 09, and it gives me a map number, right? Gives me all this other information. But if you come down here and click on the most recent deed of trust, it's a link and it will bring you, we're going, this is mortgage like 201 here. We're getting down deep and dirty. We still have a few.
Yeah, mortgage is the next generation.
Yeah, this is getting above and beyond, but figure I have you guys, I'll teach you something new. So this is where you're going to pull up the actual legal owner of the property, right? You can take a look to see this is a second home. They'll always put a rider in here. So if it's a condominium complex, they'll put a condo rider. Sometimes it's a PUD, you guys, and if it's a planned urban development, it doesn't matter. It may look and smell like a condo, but if it's a PUD, you don't have to worry about like getting a condo approved. So you'll have any kind of riders checked off here. But on the last page, scrolling all the way down, you're gonna get to a legal description. Usually the last page right here is your legal description. Okay. And so on here, it says all portion of Woodland Acres, right? So if this was any kind of condominium complex, this would tell you the condo name, the legal condo name that it's saved as, right? In the city, recorded as, right? And that's the name that you would go off of, whatever is in this document as the legal description. That is, it supersedes everything else. I'm trying not to say the word Trump anymore. It supersedes everything else, right? So just be mindful that even if you have on Redfin somewhere where it says an HOA, that may or may not be the real name of that HOA complex. All right. So just a little quick nuance to kind of be able to look up these condos correctly. Okay. So yeah, what do you guys think? That was a lot. Good little refresher course. Awesome. So listen, next time, I don't know what we're going to be doing next week, but if you guys have any kind of questions, if you guys have any kind of topics, thanks, Christine. Please feel free to reach out and to ask us, and we'll gladly cover whatever you guys want us to cover. Jumbo loans, we don't cover them because they're a whole separate other animal. Where Fannie Mae and Freddie Mac kind of control 98% of all the loans out there. I'd say 9 out of 10 easy, right? Jumbo loans has individual investors. So like Chase's, the Bank of America's, the Wells just stopped doing them altogether. Goldman Sachs, Citibank, US Bank. And yeah, I wasn't going to say I was going to wait till the very end, but happy birthday, Mateo. You're an old man today. So your jumbo loans, every single bank has their own rules to them. So it's really complicated to be able to cover jumbos in general. But what I can tell you, like I said, is your debt to income levels are a lot lower, okay, with jumbo loans. They're a lot stricter. Your reserves are always required, especially if you're a first-time home buyer. Shoot, sometimes they ask for 2 years of reserves. And then they're just a lot stricter on appraisers. They're a lot stricter on all their guidelines. Everything has, I mean, honestly, you guys, Wells Fargo was like 573 pages of guidelines. Conventional loans is like 30, right? I mean, it makes it much more complicated to do the loans, and we have to read through all these guidelines to make sure when we're in these jumbo loans that we're not goofing something up. So it's super important for us to know these things inside and out, not for you guys. Just know that they're harder to
diving into tax transcripts and stuff like that with jumbo.
Yeah, it gets gnarly. So you guys, we hit an hour. I promised I would keep it to an hour. We're at 103. My apologies. Thank you guys so much for being on today. Really love seeing everybody first thing in the morning. This will be recorded. If you guys need to go back, it's on my YouTube channel. I'll have it on there within the next couple hours. And as always, feel free to hit us up if you need anything. All right. I hope you all have a great week. You guys take it easy.
Thank you, everybody.